Well, thank you, Paul. It is very true that the first time we met was about 55 years ago, and I was walking on the 9th floor, the research floor of the Federal Reserve Bank, and there comes this tall individual towards me. And I said, "Who is that?" And I introduced myself, and I looked up, and he said, "Paul Volcker." And I said, "Henry Kaufman." And I realized sometime later, it was that enormous height that really contributed to his success. No, it's quite true, because here he is, he oversees everything. He can see into the distance. He can see what's coming around the curve. And he always has that head out like this when he's walking. And I believe very strongly that if it wouldn't be for that, Paul Volcker wouldn't have been Paul Volcker. Indeed, I would tell you personally, I can't really do that. No matter how much I get on my toes, I can't get over there. Not only that, but my doctor recently told me that in the past year I lost 1 inch in height. So I am suffering so much more. Now, I will have to tell you that, among other things, that if we in the United States would give out an award or designate people to be living treasures, there's no doubt that Paul Volcker would be among the first that would be on that list. It is a delight for me to be on the same program with Jim, whom I've known for some time and have admired. And I want to thank you for the honor that you bestow on me tonight. Ever since its founding in 1918, the Foreign Policy Association has played a vital role in shaping our understanding and awareness of U.S. foreign policy and global issues. That role is even more important today than it was when this organization was founded. Today, the global economic and financial situation is, as economists would say, in disequilibrium. Stated more simply, it is in disarray. No matter where we look, it is difficult to find solid economic, financial, and political footings today. Europe is mired in a financial quagmire from which it probably can't escape without major overhaul of its institutional arrangements. Japan, although still a leading economic power, has been struggling to regain its momentum for more than a decade. The U.S. economy has not languished as long, but it has recovered haltingly and subnormally. Not surprising, therefore, many experts are pinning their hopes for global recovery on key developing nations, especially China, India, and Brazil. This is not a well-founded hope, however. The economic vitality of these developing nations is still linked, importantly, to the welfare of the more advanced industrial countries. None of these 3 emerging economies possesses the kind of legal, financial, and political institutions, either individually or collectively, that would allow it to replace the US dollar as the world's key reserve currency. Now, to be sure, American dominance has receded from its earlier heights when the US helped win 2 world wars, establish a set of key international economic and political institutions, and rescued quite a few developing nations from difficulties. Nevertheless, the US remains the world's economic and financial center. But as we struggle to regain stability and reform our financial institutions, I fear that we will not create a financial structure that will support a vibrant economy over the long term. Now, what is the root of the problem, both here and abroad. It is, simply put, the relationship between creditors and debtors. There can be no creditor without a debtor, and no debtor without a creditor. This relationship can swing between harmonious and tenuous over time. It looks harmonious when creditors lend and borrowers borrow. Indeed, under such circumstances, the credit environment often becomes quite exhilarating. But just when accommodation between creditor and debtor becomes virtually seamless, the relationships will teeter towards acrimony. And when that happens, instability in the credit system can threaten the very foundations of our economy. Consider the current situation. Today, vulnerabilities in our credit system are probably much greater than in previous periods of financial travail. Global financial markets are, of course, much bigger than in the past. But more than that, financial markets and institutions are now linked together more intricately than ever before through a nexus of complex financial instruments. 30 years or so ago, the relationship between creditors and debtors involved mainly loans and bonds. When problems arose, it was easy to discern and measure each party's role. This is no longer the case, thanks to the myriad of financial arrangements, including all kinds of derivatives and many obligations that serve as cash substitutes, such as repurchase agreements, money market funds, and so on, and commercial paper. As some of you may know, now I spent part of my early career in the financial markets analyzing credit flows. Those helped me to appreciate the institutions and dynamics of financial markets, especially the interplay between creditors and debtors. Quite a few years ago, I became concerned about debt increasing more rapidly than nominal gross domestic product. By the eve of the crisis in 2008, non-financial debt exceeded GDP by $19 trillion. Compare that with 20 years earlier, when non-financial debt exceeded GDP by just $4 trillion. We are now finding that there are no easy ways to close that gap in order to achieve viable relationships between creditor and debtor, and thus return to a path of more sustainable economic growth. Although households have been reducing their debt, their indebtedness is still quite high by historical standards. To encourage them to significantly increase their borrowings would be folly, especially when personal income growth is restrained by high unemployment and global competition. For their part, businesses have also slowed their borrowings in recent years, and quite a few have extended the maturity of their liabilities. However, the much-lauded improvement in corporate liquidity has been overstated because it is highly concentrated in relatively few business corporations in a handful of industries. The dominant borrower in our credit markets lately has been the U.S. government. Without its large borrowings, the economic recession would have been deeper and the business recovery subnormal, as it has been, and it would have been delayed. At the same time, large increases in government borrowings over long periods are unattainable. The U.S. challenge, therefore, is to bring private sector debt into closer alignment with sustainable economic growth and to slow the total growth of U.S. government debt in the years ahead. But therein lies the rub. Credit market participants are not known for restraint. The elixir of debt is very enticing. For decades, households have been acculturated to continuous borrowing rather than deferring consumption in favor of savings. The value of the home became virtually a source of instant liquidity through a new stream methods of finance. Households and business alike, liquidity has come to mean seamless access to debt rather than savings. Credit cards are the indispensable substitute for cash. Ready access to debt has transformed many luxuries into necessities. This environment of excessive credit creation over the last few decades boosted, of course, the demand for products and services and corporate profits, which in turn encouraged firms to engage in financial behavior beyond previous norms. As corporate debt grew rapidly, the number of firms rated with AAA credit ratings fell sharply, and the universe of below investment grade bonds grew very sharply also. In 1982, Standard & Poor's rated 61 non-financial corporations AAA. Today, there are only 4 AAA business corporations in the United States. Apparently, managers of many corporations are quite willing to forsake high credit quality in order to achieve greater short-term profits. And quite a few publicly traded corporations were bought privately through massive leveraging, and some were brought back into the public sector with substantial debt burdens. It's quite unlikely that our government will adapt appropriate fiscal policies anytime soon. Near-term pressures are not strong enough to impose discipline. U.S. interest rates are historically low. Buyers of our debt are easy to find. In that sense, our government faces an accommodating situation similar to what households and businesses enjoyed for many years. Neither restrained their excess borrowings out of prudence. Rather, they ultimately did so out of economic necessity. But it would be extremely dangerous for our financial markets, for our economy, to wait until there are no more options to overcome our fiscal laxities. The stakes have grown higher, while confidence in our political will and legislative process has reached new lows. And financial regulators have accumulated a record of acting too little, too late. Financial institutions unavoidably play a central intermediary role in the relationship between debtors and creditors. In order to play an essential role in encouraging reasonable economic behavior and maintaining financial stability, they have to fulfill their fiduciary and entrepreneurial responsibilities by making profits on the one hand and safeguarding the savings and temporary funds of their clients on the other. But too often, in recent decades, financial institutions have compromised that balance by tilting too far in the direction of risk-taking. The temptation is exceedingly great. As you know, financial institutions traditionally maintain small capital reserves relative to their liabilities. They have incentives to leverage even more, for greater leverage brings higher, greater return on equity. Unlike many business corporations, financial institutions do not enjoy the benefits of patents or copyrights that would protect their profitability. New financing and trading techniques are quickly copied and exploited. Now, while there are some legal and regulatory constraints on the behavior of financial institutions, overarching responsibility for maintaining stability still rests with the Federal Reserve. This is an awesome and essential task. Our central bank should be quasi-autonomous in order to implement effective policies while remaining free of near-term political pressures. At the same time, the Fed's performance should be scrutinized. The central bank's record since World War II has been checkered. To its credit, we have endured no economic depression in this period. And many of the down cycles in the economy have been mitigated by monetary policy initiatives. However, the Federal Reserve too often has detected and relatedly to very critical developments. From my perspective, the greatest shortcoming in monetary policy has been the Federal Reserve's failure to recognize the significance of structural changes in the financial markets and their implications for the conduct of monetary policy. The Federal Reserve failed to take proper account of the rapid rise of money market funds, the growing importance of a myriad of financial derivatives, the spread of new quantitative risk modeling techniques, and, as I noted earlier, the increasing reliance of households and business on borrowing as a source of liquidity. To some extent, this is because the Fed acquiesced to the notion of liberalizing the creditor-debtor relationship because market cycles had moderated after the inflationary binge of the 1970s. It also brought into the belief, the Fed brought into the belief that credit risk was being moderated by the proliferation of many new instruments and quantitative trading techniques. Shortcomings in monetary policy are, of course, not endemic to the United States. We have evidence of that in other countries. In the United States, the greatest shortcoming of the Federal Reserve, from my perspective, has been its failure to hold the growing financial concentration. It did not effectively oppose the amalgamation of financial institutions, especially following the demise of the Glass-Steagall Act in the 1990s. The powerful new giants were a key force driving the rapid growth of securitization, the seamless access to credit through the issuance of credit cards and equity lines of credit, the rapid and uncontrolled rise of financial derivatives, and the modeling of quantitative risk-taking that relegated subjective management evaluations to a subordinate position. Unhindered concentration in U.S. financial services has dramatically changed the financial landscape. The share of U.S. financial assets held by the 10 largest financial institutions was 10% as recently as 1990. It now exceeds over 75%. At the end of 1985, there were more than 18,000 member banks of the Federal Deposit Insurance Corporation. Now there are fewer than 8,000. Many insurance companies have merged, while others have been folded into large financial conglomerates. During the latest financial crisis, financial consolidation grew by leaps and bounds. And during this crisis, official policymakers actually encouraged huge financial institutions to merge in order to avoid insolvency and market disruptions. In the wake of the latest wave of mergers, regulators finally became troubled by what some market observers had been warning about: financial institution too big to fail, because their failure would cause systemic risk to the rest of the financial system here and abroad. The Dodd-Frank legislation, rather than taking on too big to fail, has enshrined it. Besides addressing the problem poorly, Dodd-Frank is unclear and verbose. Greg Drill, who is here tonight, recently called to my attention that at the time it was legislated, the Dodd-Frank Financial Reform Act comprised of 383,000 words. With the ongoing amendments, it's probably more than 400,000 words. Now, in contrast, consider the brevity and the conciseness of the world's greatest documents. The U.S. Declaration of Independence, 1,300 words. The U.S. Constitution, including all 27 amendments, 7,800 words. The Gettysburg Address, 286 words. And above all, the 10 Commandments, 179 words. The Dodd-Frank legislation calls for the orderly dissolution of too big to fail institutions that might become financially vulnerable. A government organization will manage the process, but orderly dissolution is extremely difficult to achieve. Our financial conglomerates are entangled with many markets, many financial instruments here and abroad. Untangling these credit relationships will affect prices and other market relationships. Who will take the losses? Who will take over the assets and liabilities as dissolution proceeds? It's reasonable to assume that one way or the other, a good portion of assets and liabilities will be acquired by other institutions that are either deemed too big to fail or perhaps by one of the official institutions of the government. Either way, the entire process will increase financial concentration. Now, my opposition to the rapid increase in financial concentration is rooted in a couple of basic observations. First, the high concentration of assets raises troubling questions about how the Federal Reserve will be able to conduct monetary policy. When monetary restraint is required, who will be affected the most? The fact is, institutions too big to fail will be largely insulated from central banking constraint. That will leave the smaller institutions to experience the brunt. Under increasing pressures, some will finally be incapacitated, will fail, or will be forced to merge with other institutions. As a result, financial concentration will increase. Second, as financial conglomerates continue to grow, conflicts of interest will be unavoidable. After all, these firms operate on both sides of the market as portfolio managers, institutional investors on the buy side, as underwriters and dealers on the sell side, and as financial advisors on both sides. And third, in the tradable market for securities, the spread between bid and ask prices will widen, reflecting the market power of the few remaining market makers. This is especially troubling given how few players there are today compared with a decade or two ago. The volatility in the value of securities will increase with growing concentration. As the number of market makers dwindle, the depth of secondary markets will decrease as well. The high concentration in money management will harmonize market views rather than encourage diverse opinion. Under these conditions, views on the value of financial assets will change sharply, which in turn will periodically encourage more rather than less government intervention. Financial concentration will reduce ready access to financing by small businesses. Large institutions are not geared to be ready and flexible lenders to small organizations. This is because, among other things, their lending and investing policies tend to be centralized, and their local managers do not aspire to dedicate a lifetime of service to the community in which they are assigned. Most aspire to move up in the management structure of the financial conglomerate. Financial concentration will increase the flow of funds to large business organizations, enhancing industry concentrations here and abroad. And seventh, financial concentration does not necessarily support the role of U.S. as the center of world financial markets. Not too many years ago, one prevailing and self-serving view held that it was necessary and desirable to allow American financial institutions to grow very large in order to compete with foreign competitors, especially the so-called universal banks in Europe. But where are many of these competing foreign institutions today? Look around. Their governments have a stranglehold on many of them. Being home to giants, financial conglomerates, obviously is not the answer to maintaining our world standing in financial markets. Now, we can avoid these negative consequences, but only with strong political will. No financial institutions could be considered too big to fail. We need to require these behemoths to downsize until they no longer pose systemic risk by spinning off some of their activities. Now, to be sure, I recognize there's no precise formula for quantifying optimal size. The process requires judgment. Still, by restructuring our financial system in this way, however imperfect, we will benefit by having more institutions subject to the ebbs and flows of the marketplace and therefore positioned to play an effective role as intermediaries between creditors and debtors. If we do not reverse the current course, however, we will continue along the same path as other leading economies of the world towards socializing our financial institutions. And I fear that will be detrimental to all. Thank you very much.